And so it's important when you look at it from the overall economic perspective that if we're trying to make a benefit in service to the Americans, that yes, it's true that some people aren't going to like the decisions we make. Because if everyone likes the decision we make, a la your current government with $36 trillion in debt, all of a sudden it becomes unsustainable for everybody. That you have to make decisions that don't benefit everybody if you want to benefit everybody. Right? Put that on a bumper sticker. Hi, it's Dre Griggs of Obsidian Wisdom. Today we discuss the Fed's rate cut and what it means for our retirement. So the Fed last week, they said, what we're going to do is we're going to lower the rate another 1/4%. And what that means is they went from the range of about 4.75 to 5 level to 4.5 to 4.75. Now, the 1/4%, you're probably sitting there thinking, okay, Dre, I know they lowered the rates before. I know that we raised it a couple years ago. So what does that mean for my overall retirement? And so to help us to be able to answer that, I've actually gone through his entire speech. I went through it multiple times, the 5 to 10 minute opening statement and the 30 to 40 minute question and answers that happened afterwards, where people try to get the chairman to say anything to let them know what he's thinking in the future. And he does his absolute best to not give any information because Jay is well aware that the information that he gives can significantly impact the stock market and decisions that people are making. And it actually can change the data. So he talks a lot about using data to help them make the decisions. And if you end up changing the results that were going to happen, it just makes your job a little bit harder. And so I do think that that's an interesting tightrope that you'll find that the Fed often has to walk, where they try to give enough information where you're comfortable that the Fed is going to do the right thing, but at the same time, not giving so much information that it changes the decision-making process. The first thing we'll talk about today is what is called the Fed's dual mandate. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. So when you look at the dual mandate, we've talked about that, where the Fed says, look, we have two goals, and our goals are pretty simple. We want price stability and we want full employment. Now, price stability is pretty important when it comes to retirement planning because that means that we don't have a lot of inflation. For most people, you don't need me to say anything more about inflation because we just went through 40-year highs, but we don't want things to go up in price that is not in a sustainable way where none of us can afford anything because the dollar is worth so little that you and I would rather trade the dollar for gold, or we'd rather trade the dollar for 5 chairs so that we can sit on our porch because the 5 chairs hold value better than the dollar. Price stability can cripple an economy, not just our retirement plans, but it can cripple the whole economy. Because if you remember when all the sanctions first started happening against Russia, they were trading the rubies out very quickly because there was concern that just holding these rubies for an extra day would significantly decrease the value that I have in being able to purchase something. And you just don't want that. So price stability gives us the ability to believe in our currency as much as we can, knowing that there's debt. He's just talking about the monetary policy. The fiscal policy is what our Congress does, and that's another video for another day. And then when you talk about maximum employment, balancing the price stability. So we don't just want full employment because that's what we had last time, where a part of our inflation was measurable through the full employment. Because the only way that I am able to recruit the best talent in a full employment market, for most people, that means I have to pay you at least 10% more than what you make. I know that when I was a corporate American and I would go back and forth with different jobs and I would have the interviews, if they offered about what I was making, unless I had a really big issue with my direct supervisor or I didn't like the distance I had to travel to get to work, for most of us, we're not going to change jobs for the same salary. And so if we have to continually increase people's salary in the labor market, which we just went through with COVID, that all of a sudden creates significant extra money in the economy and everyone's buying stuff, and that can increase the price of things. And so when you take a step back, you'll sit there and say, okay, so they want to have a certain amount of unemployment with a certain amount of price stability as far as the money that's in the market. Point number two, I took his best quote on economic strength and inflation. He says the economy is strong overall and has made significant progress toward our goal over the past 2 years. Inflation has eased substantially from a peak of 7 to 2.1% as of September. And this quote and the rest of the quote should always be looked at through the prism of the Fed's dual mandate. So when we're talking about economic strength, that is good for our investments. If we're investing in businesses, if we're investing in real estate, we're investing in the stock market, which is indirectly investing in businesses as well, then that means we are tied to the strength of the overall economy. That these are all assets that perform very well during times of great economic growth. And so the Fed is trying to maintain that economic strength, even though they're trying to lower inflation. And so when you look at lowering inflation, you see that it went from 7 to 2.1%. Now, of course, we don't always keep track of all the factors that you and I would keep track of when we talk about inflation. Like that 7%, you and I would say, well, inflation was much higher than 7%. And the reason is we're looking at food and energy, which is the gas that we put in our vehicles to get from point A to point B. And obviously, the food that we buy at the grocery store so that we can afford the things that we eat. Well, those factors are normally not counted in the inflation that the Fed is monitoring. I know it sounds kind of weird, but that's one of the things that they do. Same thing when you look at unemployment, where unemployment has this little funny line where it has to be people actively trying to look for work, but it can't be people who maybe gave up, where they're trying to find a job for 6 months and they couldn't find it, and so they stopped looking. Well, they would come off and could technically lower unemployment, even though they still want a job. And so we won't go into the nuances of the data, but it is important to note that there is the way that they aggregate the data and then they've shifted where you and I may be thinking based off the title, okay, we're talking about inflation. Inflation was at 7%, it went to 2.1%. So I feel pretty good about that. But when we take a step back and look at how they're calculating inflation, where we look at the methodology, the way I would describe it is think if you were to go online and look at best places to travel for vacation, they are going to give you their methodology. Did they choose it based off of cost? Did they choose it based off of weather, family experience? Like, what did they choose it off of? Because if I change the methodology, the factors that I want to consider, that will change what my ultimate results are. And so when the Fed, they feel pretty good as far as economic strength and progress on inflation. Their goal is 2%. They're right around that 2%. Third on our list, we're going to talk about adjusting policies. The Fed chair said today the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 0.25%. And for those that don't know, the FOMC stands for the Federal Open Markets Committee. It has 12 members inside of it. There are 7 members of the Board of Governors of the Federal Reserve. There is the president of the Federal Reserve Bank of New York, and 4 of the remaining 11 Reserve Bank presidents who serve 1-year terms on a rotating basis. So this group of men and women get together, they look at the data, and they make decisions on the overall monetary policy, whether we should be restrictive or less restrictive. And they decided, looking at the data, which we can only assume the data is showing some concerns as far as where we're headed. And when you talk about the soft landing, so far they've been doing a pretty good job. When you talk about a soft landing, the concern is, okay, we've got inflation under control, but because these are lagging indicators in some ways, that means that we have to start turning off the restrictive policy before it pushes us from a recession into a depression, right? And the way we normally describe it is we say, right, like big ships turn slowly. So you can't just wake up one day and say, all right, we're there, 2%, let's go ahead and cut the interest rates, because it's already going to take 1 to 3 months for the decisions you make to truly show their impact in the market. And so ultimately you have to make the decision a little bit early. That's really in a nutshell why the idea of a soft landing is so difficult, because you have to make decisions before it's actually happening. And you can look no further than inflation we had a couple of years ago. There was probably some signals that were readily available as far as deciding that we should probably start lowering interest rates. But there's probably some pressure on the Feds that was like, well, you don't want to push us into recession too quickly. Maybe you should wait a little bit just to be certain. You also had us trying to come out of COVID. And so everyone was very excited, and the Fed was printing a lot of money. Everyone was getting jobs. Interest rates were at all-time lows. Everyone was buying houses. And we had these crazy bid wars where people were paying $100,000, $200,000 over asking price because it just didn't matter, right? Everybody had enough money, so they didn't really care what the price of things cost. We can all look back and say, yeah, you probably should have started increasing interest rates because people were making crazy decisions with their money. Well, the Fed didn't. And so then inflation kept going higher and higher and higher. And then the Fed said, okay, let's start having their restrictive policy. Let's start making it where people start losing their jobs. Let's start increasing rates so people can't buy houses. let's stop giving out all this free money that we call quantitative easing, where businesses were able to spend a significant amount of money because the return was so easy for them to make. And so now the Fed is saying, all right, we don't want to make that same mistake again. We already saw what happens when you have too hot of an economy. We don't want to wait and be late and see what happens when you have an ice cold economy. And so the Fed is trying to balance that. And so when you talk about lowering interest rates overall, that lets us know that they are still concerned that there is a recession that is looming, a deeper recession that is looming. And so they're trying to keep us from going into that. If all the signs showed economic growth, they probably would have held us flat. But as I had mentioned to you before, and I'll put a link to the video where I'll share it with you, the Fed wasn't going to decrease the rates once and not do it again. That's just not how it works, because if it only required one decrease, then that means that it could be something that we could just wait and see, where the economy just kind of has this range and everything's okay. Now, you almost knew that they had to decrease the rates multiple times just for them to take action. We already knew that. And I wouldn't be surprised if they decrease the rate at least one more time, but it's definitely possible that they'll hold steady. They won't increase or decrease the rates the next time they come out. But I would say once they look at the Christmas data, and we'll see how everybody spends and how all that goes, they'll then come back to the table and say, all right, based off of Q4, what do we want to do? And I'm probably going to be someone that's going to guess that after Q4, that they're probably going to lower the rates again, that I would probably see at least one more. But I do think we're getting very close to what the Fed is looking for, which leads us nicely into number 4, which is monitoring economic conditions. So Chairman Powell said, we are not on a preset course. We will continue to make our decisions meeting by meeting. And all the Fed is reinforcing is the idea that they have data, they have analysis that is done, and based on that analysis, they then decide whether or not there should be additional rate decreases, whether we should hold steady, or whether there should be rate increases. Now, as you all know, data is data, it's numbers, but it comes down to what the Fed, what the FOMC thinks about the data as far as whether it speaks positively or negatively about the economy. And currently, we have to acknowledge that they're doing a good job overall. While they're late to the party in the current environment, they're actually doing a pretty good job. That the numbers look pretty good. You see that the overall employment has kind of steadied off. We're not having 400,000 or 500,000 jobs added in one given month, but we're also not losing jobs either. That we just sometimes have lower job numbers where it's maybe 50,000, 100,000, but they haven't caused this to net lose jobs yet. We also look at the interest rates where they've been lowering, but they're not so low that everybody is trying to refinance their house, where everybody is trying to start a business. So right now we're moving in a very steady and methodical approach. And all the Fed is saying is that based on these decisions that we make, we then read the data. We then see if the indicators that we are targeting are decreasing or increasing, if they're showing positively or negatively to the actions that we've taken. And then based off of that data, we'll then make adjustments, which is probably the way that you really have to go. You can't look at data from 6 months ago and say, okay, that means that we should have 5 rate cuts, because the data, obviously 6 months later, might say that you should have 1 rate cut, or it may say you should have no rate cuts. And so the Fed is just reinforcing that idea, because that's what the people were asking. They were saying, hey, what are you going to do next month? And the Fed's like, we don't really know what we're going to do next time. We're going to make the decision today, and then we're going to absorb and follow the data, and then we will make a new decision based off the new data when we're given it. Our 5th quote is on balancing risk. We know that reducing policy restraint too quickly can hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. And what Chairman Powell is saying is the Fed doesn't want to create a lot of volatility in the market, that we don't want interest rates increasing, decreasing by 0.5 point to 1 point, where all of a sudden the market is great this day and then it's tanking the next day. And then people are uncomfortable, they're leaving the market. Businesses, they're uncomfortable, so they're not sure that they want to invest, because there's so much economic instability, there's so much uncertainty about the future, that a lot of people will just sit it out on the sidelines. That if we don't know what's going to happen, the safest thing we could do is wait to see what happens. That's normally what the smart money does. And if we're going to see that, all right, well, the Fed is not 100% sure what they're doing, right? Like the Fed last month said, we needed to lower rates, so we lowered rates. And then this month they came out and said, we got to increase rates, and they increased the rate by the same amount that they lowered it last month, that would be a sign that the Fed is not 100% sure what they're doing, that they're undoing their own mistakes more than they're trying to correct and adjust the overall economy. And when it comes to you and your retirement, you want that balance. You want that stability. You want to be able to invest your money and know that your investments are relatively safe and that they're going to grow over the long term. You also don't want to have to deplete your savings because the rates keep going up and down and the economic instability that now you have to leave your money out of the market because you can't get enough of a return to beat inflation, just to keep up with your normal, standard, everyday cost of living. The Fed understands that, and they know that how people feel about the market is even more important than what the data says about the market. And so sometimes it's not only about winning, it's about how people felt along the journey towards the win. We may end up in the exact same spot, but if it was a very bumpy ride or there was a car accident or we got stuck in traffic or we had like 4 flat tires, we don't feel as good about getting to the right spot, that the cost of the journey was very significant to where we don't feel it was worth it, where we may say, you know what, next year I'm not taking that trip at all. And that's what the Fed is trying to make sure that we don't say, you know what, I'm not taking that trip. I'm pulling all of my money out of the market and I'm just going to take whatever the rates are that the bank offers me on a money market account or a CD, which may or may not be able to keep up with inflation. All right, we're halfway through the Fed's press conference. Hopefully you're finding value in this video. If you are, go ahead and give me a like and subscribe so you can always stay up to date as we give up-to-date market analysis. Number 6, we'll talk about the labor markets. The labor market is not a source of significant inflationary pressures. Conditions in the labor market are now less tight than just before the pandemic in 2019. And so the Fed is acknowledging that they have been taking steps to cool the labor market. As we have discussed previously and at different times, when we have full employment, that means it is an employee's market. You have all of the leverage. You get to decide when you're going to leave. Everybody's got a job. That means that the only way you can be convinced to move to another position is to offer you a higher title, is to offer you better benefits, and most of the time to offer you better pay. And when you look at the pandemic, because so many people were laid off, because so many businesses weren't working and everybody was kind of cooped up in their house, as soon as people were allowed to leave and they were getting these new jobs and these raises, they started buying everything. And as we kept buying and buying and the shelves kept being empty and empty, eventually the businesses are going to say, I guess my prices are too low. And if my prices are too low, I'm going to increase them when I get my next stock of inventory. And then the second thing is I have to pay my highest expense, which is employees, more than I used to pay them. Because I'm paying them more because of this red hot market, I now have to increase my prices to cover the cost of additional employees, to cover the cost of higher paid employees. And so when you mix these two things together, now obviously there were other factors. We talked about the logistics and everything kind of getting tied up in customs and different things with COVID. But the labor market was also causing a lot of inflationary pressures on our economy. And so when you look at your retirement, you talk about cost of healthcare, the cost of food, and the cost of energy, gas, and traveling, that all these costs were up a lot. And you weren't making that in 1 year. Because as you get closer to retirement, you don't necessarily have the ability to go for the 10, 15% returns anymore. That you're focused a little bit more on capital preservation, that sure, you would like to be able to get maybe a 3 to 7% return. But because inflation was higher than that, that meant that you were losing money in your retirement, which is a very rough situation to be in because we weren't interested in going out in this new market and getting that job that everybody was getting these raises to get. When you're retired, then your income is fixed. It is what it is. And some of you have cost of living adjustments on your pensions. Well, in that case, right, obviously we're doing good. But we don't all have that same ability. And so now we have to go out there and either change our lifestyle because we have to spend the same amount, or we have to go for riskier investments, which naturally is not always the safest choice. But when you look at a red hot economy, it can feel very inviting. It can feel like everybody's winning, that everyone in the stock market is getting gains, their investments are growing. So maybe I should take the risk with them. That you keep seeing these companies going well. And of course, that's what happens in times of high inflation. Normally, that means that the company's charging more, everybody's working, and everything still is flying off the shelf. Well, obviously, a lot of the times in the very beginning of that, there's a lot of economic growth and expansion. And so it can feel that way. But if you know the cycle, as we've been talking about, we both know that eventually hit the peak and then you start going down. And so we have to know ahead of time that we're going to hit the peak when we have high inflation, full unemployment, and then eventually it's going to go down. So we can't invest our money at the highest time, at the highest prices, and then all of a sudden we lose it. And it's also true that we probably don't want to go back to work at those higher wages, because what often happens, and this is part of the reason people make that saying where they say last in, first out, is not that inherently you just get fired because you were the last one that was hired. More times than not, it's because the last in is actually getting paid significantly higher than the average employee. And if that is the case, then you normally get rid of your highest cost. And I'm not saying it couldn't also be because you were the last in, so nobody knows you and it's easy to fire you. But what I am saying is it's normally the money. I have found throughout my career and interactions that if you follow the money, you normally can explain most things pretty easily. Our seventh quote is the approach to inflation. If the economy remains strong and inflation is not sustainably moving towards 2%, we can dial back policy restraint more slowly. And so what Chairman Powell is saying here is they still consider the Fed's policy to be restrictive, that they don't think that we're in a wild, wild west, free for all, open market, printing money, everybody's living and having the best life, that they're not printing money, that the balance sheet of the Fed is actually going down, that interest rates are still higher than they have been for the past 5, 10-ish years or so. And so he still considers us to be in a restrictive policy. And so as a result, the question is basically saying, hey, are you lowering rates too quick? Are you worried about inflation coming back and everything messing up? And Chairman Powell was like, well, I'm not really worried about inflation because we still consider our policy to be restrictive, that everybody's not going to be able to get a job, that everybody's not going to be able to demand these high increases, that everybody's not going to be able to go out and buy a home, that you're still going to be dealing with a lot of the restrictions that we have placed on the market. And so as a result, we don't think that that's going to be a concern. But if we are wrong, and the data, the next time we look at it over the next couple of months, shows that, you know what, that was the straw that broke the camel's back, that everybody has a job again, and everybody's buying houses again, everything's going crazy, that they would just hold it, that they would just say, you know, we don't have to increase it because, as we mentioned, our rates are already restrictive. And that's what the Fed is saying. We're already still in a restrictive policy. We're just less restrictive. Then because we're less restrictive, we could just hold it there. Then eventually people will hit the ceiling a lot quicker than they did when interest rates were at literally 0%. Number 8 on our list is on the impact to the public. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. And what the Fed is acknowledging here is they know that the decisions that they make aren't in a vacuum, that it's not on a simulator where we're running the data and it says that this is going to happen or that's going to happen, right? We're not playing Monopoly or SimCity, that they know that their decisions have real impact on real lives, real people with businesses and services that they offer, or the retirees and the money that they have in their pensions and overall. And so what he's saying is what we do is in service to the American people, but it's in service to the greater good, right? And we all know that that greater good can be one of those tough statements to make. But when we say the greater good, we're saying that as a whole, when we look at the economy, we're making decisions that help the majority of people, maybe 80% of the economy, where 10% on the top end might not like it, 10% on the bottom end may not like it, but the majority of the economy, that middle 80%, the median of the economy, is going to feel a positive impact of the decisions that we make. But they also acknowledge that prices are still higher than they have been. So people are still dealing with that. And a part of that is where we anchor our prices, that if we actually all could get ourselves to agree to continue to not buy something until the price goes back to where it used to be, then the price would continue to drop. But unfortunately for us, we do what's called price anchoring. And I'll use a gallon of milk in my example because it was something that I went out, I was just very surprised by the price. But you can really use anything that you spend your money on. A gallon of organic milk before COVID was probably like $3 a gallon. But then when we started going with the high inflation, I remember seeing a gallon of milk for $10, to where I was like, wow, a gallon of milk for $10. Well, if you've been paying $10 for a gallon of milk, and then you see the gallon of milk's price start to go down, you're going to take another look at it. You don't necessarily remember that it used to be $3. You remember that it used to be $10. So it could go down to $5. It can go down literally 50%, which is great compared to $10. but that's still almost 35% higher than it was when it was $3 a gallon. And that is where we end up falling in these times of inflation, where inflation jumps something up to like $10 per gallon of milk, but we used to pay 3. But when it decreases to $5, $6, we feel that that's a really good deal. And now everybody's buying the gallon of milk again off the shelf. And then the business is saying, all right, I guess that's our price. There's no reason to go down any lower. It's sold out over the weekend. And that's true across the board. And there's gas stations where the price of gas was maybe $2 a gallon. Then it went up to $4 a gallon. And then it went down to $3 a gallon. Everybody said gas is at a great price. We're all buying it at the $3 because that is a significant savings from the 4. But we forgot, because of our new price anchor of the $4, that it used to be 2. And so if we were ever able to remember what the price was before the crazy inflation, and we all stayed kind of restrictive in our own spending, then they would continue to lower the prices. Now, I don't know how we get everybody to make that agreement. I don't know how we talk to everybody, but I'm doing my part by mentioning it to you. You do your part by mentioning it to others. And then we will do the best that we can, obviously, with making these decisions. The Fed acknowledges for us to have price stability, there has to be people without jobs looking for jobs. Because if there is a scarcity in the sense that you just can't go out and get a 20% increase tomorrow if you wanted it, but you would really have to weigh the pros and the cons of leaving the company and getting a new job in the market, that means a lot more people are going to stay exactly where they are at. It also means that a lot of these people who are waiting for their perfect job, where they're sitting there and saying, look, I'm not going to work for less than $100,000. Right? I want to be 6 figures. I'm not going to work less than that. And you can go and get that in a week. Well, that's not a difficult decision. But what if it takes you 8 months, a year to get that job? Most people are going to go back to work before then and work in something that maybe isn't their dream job, but at the same time, it's something that pays the bills, keep the lights on, and gives them the leverage and the time that they need to then look for that perfect job. It just slows the overall economy in that process of increasing wages down when we don't have full employment, because the leverage shifts from the employee to the employer. The way the Fed would describe themselves is they're the neutral middle party, that they're just making whatever decision helps the overall economy. So that may be a decision that positively impacts you. It may be a decision that negatively impacts you, but they're just making the decision that helps the overall economy, where we don't have full employment because that ultimately leads to inflation, where money is not available to everyone, and to where everybody can't buy a house. Because when everybody can participate, it does cause things to go up in price, because there's only so much supply of everything. And so the only thing I can do to differentiate my product is by charging more. And if you look at college as a great example of what happens when there are no financial restraints, that it's a great idea for everyone to be able to afford college, right? Like the concept, that idea is a great idea. But economically speaking, if everyone can afford college, then the only thing a college can do to differentiate itself is to charge more. Because if they have 10,000 people that they can let into this year's college, and there are 40,000 people applying, well, they can just choose the top 10,000 and charge significantly more, because they know that everyone is going to be able to get a loan for whatever that amount is. And as a result, college goes up much higher than regular inflation. That colleges go up about 6% on average. Your healthcare is another great example of that. Because for the most part, we're paying deductibles, then we rarely have to pay the entire bill. The hospitals end up charging more because they know that as far as you and I are concerned, that we're going to pay that set amount, and then they can charge whatever they want to the hospital. That the average person isn't going to be concerned with that. They're like, well, that's just what health insurance does. But what we don't know is everything is connected. And because everything is connected, right? If I could tell you the one thing about economics that makes it easier, or at least enjoyable for me, is the idea that everything is connected, that nothing happens on its own, that every cause has a reaction, every benefit has a cost. And so when you make it for everyone to be able to have health care, or you make it where you make your deductible payment, and then you pretty much don't have to pay anything else after that, we feel that, all right, well, it costs me $100. So whatever they charge my insurance company, I'm not really concerned about that. But the reality is next year, when you go back and you get your new insurance policy, what has happened? your insurance has increased by like 5, 6, 10% sometimes. It's because the insurance company is taking that crazy number that they were charged for your visit that we paid the deductible for, and then they aggregate it over all their policyholders, and then they increase how much we pay. And so all that really means is while we feel we're just paying our deductible and we're not getting charged for anything else, the reality is we're always getting charged for everything else. It just comes a year later when they recalculate how much we pay in premiums and what our deductibles are and all that jazz. And so it's important when you look at it from the overall economic perspective that if we're trying to make a benefit in service to the Americans, that yes, it's true that some people aren't going to like the decisions we make. Because if everyone likes the decision we make, a la your current government with $36 trillion in debt, all of a sudden it becomes unsustainable for everybody. That you have to make decisions that don't benefit everybody if you want to benefit everybody. Right? Put that on a bumper sticker. I think I may make a bumper sticker. You guys can put that up on a bumper sticker. All right. So number 9 on our list, we'll talk about inflation and employment goals. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. And all the Fed is saying is that that 2% number that we're shooting for, if it goes up 2% every year, that is long-term economic sustainability. That is not unreasonable for an employee to get a 2 to 3% raise every single year. That is not unreasonable for you to see that your price went up by 2% of something from year over year. That there are certain things that we just expect that that's reasonable, and it would not be a shock to the system where we would say, you know what, this is crazy. I don't want to buy anything. I don't want to work. I don't want to do all these things because I don't know what's going to happen. I don't want to invest. Everything is just going crazy. That long term, if you're around 2% for inflation every year, that most people are going to be able to make economic decisions that are good for their family, that are good for their business, that are good just overall in the economy. As long as people feel comfortable with the decision-making process, that the information that they have today is going to be relatively the same next year, that people are comfortable making long-term decisions. That's part of the reason when you looked at the Bush tax cuts from '01, the reason that it was seen, generally speaking, as a failure was because most people, if you just give them $600 once, they don't see any reason to change their overall life decisions because I don't have that $600 next year. So why don't I go buy a car today that is a 5-year payment when you just gave me $600 once? And that's how most people make economic decisions. It's very rare, and obviously there are some, but it's very rare that someone is going to make a long-term decision with a short-term interest. And so as a result, the Fed is committed to making long-term interest so that we can make long-term decisions, which then benefits the overall economy and the market. That you could definitely make a strong case that when you look at some of the metrics, that the economy right now, 2024's economy has done pretty well overall. But when you look at other metrics, and a lot of it has to do with the choppiness and the instability, that people feel uncomfortable making decisions. And if people feel uncomfortable making decisions, if they have anxiety about making decisions, it does change how you feel about the overall economy. And then it becomes a indicator of what's going to happen. That if everybody feels the economy is bad, even if the economy isn't bad across the board, that people are going to start making decisions based off of that belief, which will then lead us into a recession, right? And so the Fed's goal is to ensure that we're able to put budget together for our retirement, for our lifestyle, for the decisions that we want to make. And we feel relatively confident that that budget is going to stick for at least a year, but ideally for 5, 10 years into the future, because that's how we want to be making our decisions, especially when we talk about retirement. We want to be able to make decisions today that impacts our retirement in 10 years. In our 10th and final quote from Chairman Powell at the last press conference, he talked about the importance of caution. And so he says, we think that the economy and our policy are both in a very good place. We're in the middle trying to manage the risk on both sides, meaning that we're not in the clear of a recession, that we're not necessarily at risk of going into another inflationary environment, that we're sort of in the middle. We're in that wait and see approach. The Fed's lowered rates by 0.25%, and they want to see what that does to the economy over this Black Friday and Christmas shopping and all this other stuff that's going on. Because the fourth quarter is already relatively hot, but they just want to see Are people comfortable spending money on Christmas presents? Are there enough people available to get these seasonal jobs that are going to be willing to work over this Christmas break? How busy is our overall economy going to be? We don't want to take too much information, but we do want to see how people feel about the economy. And so the Fed's going to take that information, obviously look at the data, and then they would come back to the table and make another decision because they know if they lower the rates by another quarter, 0.5%, and it ends up being too much, then all of a sudden we're going to be fighting inflation again. And they're going to undo everything that they've been trying to do for the past 12 to 18 months. That it will be gone with one bad decision. And the same is true on the other end, that they're trying to make sure that we have that soft landing, that we don't fall into a recession where there's already tens of thousands of people being laid off, that we've had some lower job numbers, but not overall, that it's just not a red hot labor market. Prices have started coming down some, but not all the way down where it's unreasonable. I think you said we're in pre-2019 pandemic levels to where he doesn't want to drop us into a 2008 recession. And so we're right there in the middle, which is why it wouldn't be crazy for the Fed to just hold next time, but it's also why I'm someone who thinks the Fed's probably going to lower rates at least one more time, just based on the overall data that they mentioned at the press conference. It seems that there's still a lot of concern about a recession, and that they're most likely going to lower rates at least one more time, which naturally, when you look at overall retirement and planning, that it's something that we have to evaluate because that does mean that investments in equities and real estate are going to be performing better. Because as the interest rates go down, more people are going to be interested in selling their house because they can now get a rate that's comparable to the one that they have. People don't want to sell their 3.5% home mortgage for a 6-7% home mortgage. But at the same time, people don't want to also be getting bonds in their retirement where it's now going to be at 3-4% when the bonds a year ago were at 6%. And so we have to balance this. That's what the Fed is saying. That's their caution. Their caution is everybody has different needs that they need from the economy, but we have one economy. And as a result, they have to balance that, as we mentioned, where the majority of Americans are saying, okay, this makes sense. And then, yes, that does mean that it does negatively impact some of the edges. It can negatively impact the young people as they're coming into the market. It can negatively impact some of the retirement plans as we're leaving the market. And then the people in the middle, they're relatively okay because that's who the policy is focusing on. And so we have to make changes to our plans if we're on the edges based on what we're seeing in the market. And so what you can see here is the Fed really focused on their dual mandate, price stability and maximum employment, not full employment, but maximum employment. Some difference, but a key difference nonetheless. And then you have to look at that and decide, what should I do when it comes to my retirement plan? How is that going to impact me, the volatility, the interest rate? And what can I do to mitigate some of these risks? And what can I do to benefit from some of these changes? All these come into your retirement plan. If you were someone who was interested in having a conversation and seeing if we're able to at least get a second opinion on your plan, we do give complimentary retirement readiness checkups. I'll put a link in the show notes where you can learn more. As always, I'm thankful for your time. Until next time, stay safe and enjoy life.